All right, let's dive right in. Today, we're going to break down two really different ways to get your money making money in the stock market. We're talking about the instant gratification of high-yield stocks versus the slow and steady power of dividend growth. I mean, isn't that the dream for so many of us? To set up a system where your money is actually out there earning more money without you having to lift a finger? And that, my friends, leads us straight to this beautiful concept called passive income. So what are we really talking about here? Well, even the IRS has a definition for it. They basically say it's money you make from something you're not actively running day to day. Think about rent from a property you own, or in our case, earnings you get just from holding stocks. And the goal here is pretty simple, right? It's all about giving yourself more financial breathing room. It helps you deal with rising costs and, just build a more secure future for yourself. It's about boosting the actual cash you have to spend or save. Okay, let's get into the nitty-gritty. For this explainer, we're going to laser focus on one of the most popular ways to generate passive income, dividend-paying stocks. These are just companies that literally share a slice of their profits with you, their shareholders. But here's where it gets interesting. Not all dividend stocks are the same. In fact, if you're an investor looking for income, you're standing at a fork in the road. You've got a fundamental choice to make between two very different philosophies. You can picture it like this. Are you hopping on the high-yield highway, looking for the fastest way to get the most cash in your pocket today? Or are you starting the Dividend King climb, a much slower but incredibly steady path that's all about growth over decades? Let's explore that first route. So the high-yield highway is all about one thing, and one thing only, getting the biggest possible paycheck from your investments right here, right now. This strategy is for people who really prioritize that immediate income. So who's usually cruising down this highway? Well, we're often talking about some pretty specific types of companies. Things like business development companies, or BDCs. They kind of act like banks for smaller businesses. Or master limited partnerships, MLPs, which you see a lot with things like energy pipelines. And of course, real estate investment trusts, or REITs, which own properties like apartment buildings and malls that generate income. To make this real, let's look at a case study, a company called Main Street Capital. It's a BDC, and it's a perfect example of a high-yield investment in action. Now, what's really interesting about Main Street is how it pays you. It actually has two income streams. First, there's a steady monthly dividend, which they call their income floor. But then, when the company does really well, they pay out a supplemental, kind of like a bonus dividend. And this two-part system makes a huge difference. See, that regular monthly payment gives you a solid 5.2% yield. But when you add in those bonus payments, the total yield jumps all the way to 7.2%. That's a massive boost for anyone focused on income. Okay, now let's pull off the highway for a minute and switch gears. Let's explore that second path. This strategy isn't about the biggest check today. It's all about reliability and slow compounding growth over decades. So, welcome to the Dividend King climb. So, what in the world is a Dividend King? Trust me, it's not just a catchy name. It is a super prestigious title for companies that have an almost unbelievable track record. They have raised their dividend payout every single year for at least 50 years straight. And for this path, we're going to look at two names you definitely know, true household brands, the healthcare giant Johnson & Johnson and the retail powerhouse Walmart. Both are certified Dividend Kings. Just to give you some perspective, Johnson & Johnson has increased its dividend for over 60 years in a row. Think about that. That kind of insane consistency is the foundation of this strategy. These are companies that sell things people need, no matter what the economy is doing. And here it is. This is the crucial trade-off. The starting dividend yield for a Dividend King like Johnson & Johnson is way lower. We're talking about 2.5% compared to Main Street Capital's 7.2%. You're giving up that big immediate income for what you hope is long-term growth and rock-solid stability. But, and this is a huge but, if you only look at that starting yield, you're missing the whole story. The real magic of the Dividend King climb shows up when you look at the total return. That means the dividend income plus the growth in the stock's price over time. And the results, whoa, they can be absolutely dramatic. Over the last 10 years, Walmart's total return was a staggering 560%. It completely crushed the S&P 500, which already had an amazing run. Johnson & Johnson also put up a really solid 165%. It just goes to show you that even though the starting dividend is small, the overall growth can be incredible. Okay, so we've driven down the fast highway and we've started the slow, steady climb. Two very different journeys. So how on earth do you decide which path is right for you? Let's just lay it all out, side by side. The high-yield highway is all about high current income, but the trade-off is more risk. Those big payouts can sometimes get cut if the economy gets rocky. The Dividend King climb, on the other hand, is about steady long-term growth, but you have to be okay with that much smaller paycheck at the start. It really just depends on your timeline and how much you need that income today. But here's one last really important question. What if you didn't have to choose? What if you could actually try to get the best of both worlds? Well, this brings us to a really cool hybrid strategy called the barbell approach. The idea is to build a portfolio that has two very different ends, just like a barbell at the gym. On one side, you've got your safe, reliable Dividend Kings, providing that stability and long-term growth. And on the other side, you've got your higher risk, high-yield stocks, giving you that immediate income boost. You're trying to create a balance between today's needs and tomorrow's growth. So at the end of the day, it all comes back to you and your own personal goals. Are you trying to build a portfolio that's going to spit out as much cash as possible right now? Or are you laying a foundation for steady, reliable growth that could compound for decades and decades? Which path fits the future you're trying to build?